This video will teach you the only pattern you need to catch major moves in the market before they happen. Most traders think the market is random, but the truth is this: all profitable trading is built on one core concept: market structure. If you understand structure, you'll see why trends continue and exactly when they reverse. And that's where two powerful patterns come in: the break of structure and the change of character. The core concept here is market structure. Markets only move in two ways: trending or consolidating. Now, this part is very important before we jump in. Make sure not to skip this part or you will not understand the rest of the video. In this video, we focus on trending markets, which falls into two directions. In an uptrend, price makes higher highs and higher lows. Each new peak is higher and each pullback holds above the last one. In a downtrend, it's the opposite: lower highs and lower lows, where each bounce fails lower than the last. This rhythm of highs and lows is the heartbeat of the market. Before we can talk about patterns like break of structure or change of character, it's important to pause and really understand why structure matters. Every chart you look at is telling a story: who is in control, buyers or sellers, and how long that control can last. Structure helps you see the map of the market. Are we expanding in the same direction, or is momentum weakening? Are we building energy in a consolidation, or are we breaking away? Think of market structure as the framework that supports every decision you make as a trader. Without recognizing it, you're guessing. With it, you're reading the market's language in real time. Just remember, the trend is your friend until it bends. To better understand market structure, we will break it down for you into three primary patterns. Pattern 1. Break of structure, or BOS. The first pattern we need to understand is the break of structure. This is the foundation of trading with the trend, because it shows us when the market is confirming strength and continuing in the same direction. The break of structure tells you the trend is continuing. It's your confirmation signal. Example: in an uptrend, when price closes above the previous high, structure is broken upward. That close, not just a wick, shows buyers still in control. In a downtrend, BOS happens when price closes below the previous low, indicating that sellers are still in charge. An important rule here is always wait for the candle body to close. Wicks are often smart money liquidity grabs designed to trick retail into false entries. Be careful of wicks, as this could just be a fake out or liquidity grab, which we will cover in other videos. Trading BOS means you're trading with the trend, one of the safest ways to stay aligned with the market. But what if the trend is about to end?
If you are enjoying this video so far, please take a moment to like and subscribe to the channel. Hit that bell notification to help us get the content out there.
Pattern 2. Change of character. The second pattern to learn is the change of character. This is the most important reversal signal, because it reveals when momentum is shifting and the current trend is coming to an end. That's where change of character comes in, which is the most important pattern of all. Change of character is your earliest warning sign of a reversal. In an uptrend, if price fails to make a higher high and then breaks below the last higher low, that's a bearish change of character. Sellers are taking control. In a downtrend, if price fails to make a lower low and then breaks above the last lower high, that's a bullish change of character. Buyers are stepping in. Think of change of character as the market shouting the character has flipped. The psychology has shifted and momentum is turning. Imagine this in action. You're watching an uptrend where price keeps printing higher highs. Then, it suddenly fails to break the last peak. A few candles later, price drops and closes below the most recent high or low. That isn't random noise. That's the change of character, clearly signaling that buyers have lost control and sellers are now stepping in with momentum. Pattern 3. Market structure shift, MSS. The third pattern to understand is the market structure shift. This combines elements of the first two patterns and shows us the transition from one side of the market to the other, often marking the exact handover of control. Market structure shift, or MSS, is a concept that builds on both break of structure and change of character. Where BOS signals continuation and change of character signals reversal, and MSS shows a transition phase, the handover from one side of the market to the other. Here's a clearer example. Imagine price has been trending upwards with higher highs and higher lows. Then you see a break of structure as price pushes above the last high. Normally this would suggest continuation, but instead of holding, price immediately rejects and drives back down, breaking not just the previous higher low but also sweeping liquidity before pushing further down. That sequence, a false continuation followed by a decisive break the other way, is the market structure shift. It signals that the attempted trend continuation was a trap. Smart money has shifted positions, and control has passed from buyers to sellers. Traders look for MSS because it often captures the exact moment liquidity is swept on one side before the true trend shift begins. It is a smart money footprint that price is changing direction with intent, not just noise. Break of structure versus change of character versus market structure shift, MSS. Let's compare them directly. BOS equals continuation. The current trend is healthy and strong. Change of character equals reversal. The market's psychology is changing direction. Market structure shift, MSS, equals transition. It shows the turning point where control is handed from buyers to sellers or vice versa. Together, these three patterns let you see the engine of the trend, the moment it runs out of steam, and the exact handover of control in the market. Think of it this way. Break of structure is like the green light that says the road ahead is still clear. Change of character is the red light warning that the current route is ending. Market structure shift is the amber light in the transition phase where momentum is switching sides and where smart money often positions themselves before the new move begins. By combining all three, you're not just reacting to price, you're anticipating the flow of control between buyers and sellers. 3 mistakes that cost traders money. 1. False breaks, entering on a wick instead of waiting for a candle close. 2. Ignoring higher time frames. A 15-minute change of character might look tempting, but if the daily chart is still trending strong in the opposite direction, that lower time frame signal is often just noise. Always align your entries with the dominant structure of the higher time frame to avoid being caught in false moves. 3. Chasing without confirmation. Many traders jump in the moment they see price break a level, only to get caught in a fake move. Smart traders wait for confirmation, a clean retest of structure, added confluence, or supporting volume before committing capital. Avoiding these mistakes instantly puts you ahead of most retail traders. Here is a simple 3-step trading strategy you can apply today and beat 99% of traders. 1. Start with the higher time frame, 4 hours or daily, to define bias. Always begin by zooming out. On the 4-hour or daily chart, you can clearly see whether the overall market structure is bullish, bearish, or consolidating. This helps you avoid trading against the dominant flow. For example, if the daily is showing a series of higher highs and higher lows, your bias should lean bullish and you'll focus on long setups. 2. Drop to a lower time frame for entries. Trade BOS for continuation, change of character for reversals. Once the higher time frame bias is set, drop to a more granular level such as the 15-minute or 1-hour chart. This is where you'll find precise entries. Look for a break of structure to join the dominant trend. For example, a bullish BOS within an uptrend can be your trigger to enter long. If the higher time frame is hinting at exhaustion, watch for change of character signals on the lower time frame to catch the reversal early. 3. Manage risk. Stops below the last low for longs, above the last high for shorts. Always aim for at least 1 to 2 risk reward. Risk management is what separates consistent traders from gamblers. Place your stop loss at logical structure points, beneath the most recent swing low if you are long, or above the most recent swing high if you are short. This way, if the market invalidates your idea, you exit quickly. Don't chase every tick. Focus on trades that offer at least twice the potential reward compared to the risk. Over time, this positive risk-to-reward ratio is what allows small edges to compound into significant profits. By following these 3 steps, you create a structured process, define direction, find alignment across timeframes, and manage risk like a professional. This system works across crypto, forex, and stocks because structure is universal. Why this works? These aren't just lines on a chart. They represent the flow of money and psychology between buyers and sellers. When structure breaks, or when character changes, it's the clearest message of who's in control. Learn to read it. and you'll stop guessing and start trading with the market's rhythm. Break of structure tells you when to ride the trend. Change of character tells you when the trend is ending. Together, they're the foundation of smart money trading, which we will dig into in more details in the videos that follow. The system is simple, powerful, proven. If you found this valuable, subscribe to Traders Lab for more no-hype, deep dive strategies. We break down real systems and rebuild them from scratch, so you can trade with edge, not superstition. What did you think of this content? Comment to give us feedback and help us to help you. Which pattern do you trust more in your trading BOS or change of character? What's the biggest mistake you've made trying to spot reversals? Do you prefer trading with the trend or catching the reversal? And why?